Hey everyone, welcome back to Corporate Decoder, where we're about to crack open a report from Nuveen Preferred Income Opportunities Fund. And let me tell you, you might think it is all about boring numbers. But trust me, there is a story here, especially when it comes to how this fund handles money and what risks it is taking. Before we dive in, make sure you're subscribed because we're bringing you the real talk on corporate filings. And for those of you who want to go deeper, join our Discord community, linked in the description below. Alright, let's talk about the Nuveen Preferred and Income Opportunities Fund, or JPC as it is known. This is a look at their books as of the 31st of July 2025, and to be blunt, it is a bit of a maze of preferred securities and debt instruments. Jumping straight into the financials, we see that JPC is a big player with over $4.2 billion in investments. But hang on, they've also got a whopping $649 million in borrowings, and that is just the tip of the iceberg. They were also using reverse repurchase agreements to the tune of nearly $472 million, and have issued $420 million in taxable fund preferred shares. This leverage is how they juice their returns, but it is a double-edged sword, meaning bigger gains when things go well and bigger losses when they don't. Their net assets applicable to common shareholders after all this debt and preferred share funding is around $2.6 billion. Now for the juicy part, the portfolio, JPC has a massive chunk of its assets, almost 141% in corporate bonds. This is a sign they are heavily reliant on companies paying back their debt. Look at the bank section here at over 82% of their corporate bond holdings. This is a huge bet on the banking sector, particularly major players like Bank of America, Citigroup, and Wells Fargo. They are also playing with derivatives. JPC has about $183 million in futures contracts and over $2.3 million in interest rate swaps. These are complex instruments used for hedging and potentially boosting returns, but they also carry significant risks. For example, their interest rate swaps are with Morgan Stanley Capital Services, meaning if Morgan Stanley has financial trouble, JPC could be on the hook. It is a strategic move, but definitely adds another layer of complexity and risk. Let us peek at the cost of all this JPC. Total annual expenses are around 4.67% of net assets. That is a significant chunk of money going towards fees each year, meaning a good chunk of your investment is going to pay for management, and the extensive use of leverage. They've got management fees at over 1.2%, then a hefty 3.39% just for interest and other leverage-related expenses. The bottom line for JPC is this: it is a fund using a lot of borrowed money and relying heavily on the performance of the banking sector. While they're trying to balance risk with a complex mix of bonds and derivatives, their significant debt and reliance on a few key industries make them a higher risk proposition. It is not a buy and forget investment for sure. Then we have JPI Nuveen Preferred Securities and Income Opportunities Fund. They merged with another fund, JPIS and JPT, in November, and are set to merge with JPC later this year. This constant shuffling suggests a strategy of consolidation and efficiency, maybe to cut costs or gain scale. JPI also went through a rights offering in January 2025, and another for JQC in March 2025. For JFR that brought in over $220 million, and for JQC around $62 million. This is how these closed-end funds raise more money from existing shareholders to invest in new opportunities. JPI's strategy seems to be a bit more diversified than JPC, but still heavily weighted towards preferred securities and debt. They have a significant international exposure, particularly in the UK and Canada, which adds currency risk to the mix. Their debt holdings and their heavy reliance on the financial services industry mean they re-watching those interest rates and financial stability very closely. Scroll Nuveen Variable Rate Preferred 10D AMP Income Fund, NPFD 10 Smallest. Finally, we have NPFD Nuveen Variable Rate Preferred and Income Fund. This fund is heavily focused on variable rate securities, meaning their income can fluctuate with interest rates. They got nearly $755 million in corporate bonds, and a significant chunk in preferred stocks, a lot of it in the banking and insurance sectors. Their NAV per common share is around $20.06, so they're retrading at a discount to NAV, which is common for closed-end funds. NPFD also uses leverage, borrowing around $161 million, and has preferred shares outstanding of nearly $85 million. This leverage is key to their strategy for boosting income, but also amplifies risk. Now let's talk about the risks. All these Nuveen funds share a lot of the same concerns, including credit risk, interest rate risk, and market risk. For JFR and JQC, there is a significant emphasis on below investment grade debt, which is inherently riskier. JPC, JPI, and NPFD are really leaning into preferred securities and contingent capital securities, or COCOs. These are complex instruments that can absorb losses, which means your investment could take a hit if the issuer runs into trouble. The boards of trustees for all these funds have reviewed and renewed the investment advisory contracts. They looked at performance fees and services and basically said they're happy with how the funds are being managed. For JFR and JQC, performance was below benchmark in the long run, but showed improvement short term. JPC and JPI also had mixed performance ratings, and NPFD showed some underperformance in its peer group. It seems the boards are accepting this performance for now, but it is something to keep an eye on. Scroll Portfolio Manager Biographies Grayscale. The people calling the shots haven't changed much for JPC, JPI, and NPFD Douglas Baker, and Brenda Langenfeld are still at the helm. But for JFR and JQC, we've seen some changes. Kevin Lorenz retired, and Cole Mecklin has joined, adding to the team. It's important to know who is managing your money and how they're compensated. These managers are compensated through salary bonuses, long-term awards, and profit interest linked heavily to performance, which could mean they're incentivized to take on more risk. So what is the verdict on Nuveen's preferred and income funds? They're using leverage to boost income, which is a strategy with inherent risks. JPC's heavy reliance on bonds and banks makes it a bit exposed. JPI is diversified but still faces market volatility. NPFD's variable rate focus means it is sensitive to interest rate changes. The board seems satisfied with the current management, but investors should definitely understand the risks involved, especially with the heavy use of leverage and the investment in riskier assets like below investment grade debt and complex preferred securities. That is our deep dive into these Nuveen funds. What are your thoughts on their strategies and risks? Let us know in the comments below. If you found this breakdown useful, hit that like button and subscribe for more corporate deconstructions. And don't forget to check out our Discord for further discussions. Thanks for watching, and we'll see you next time.